The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Welcome to the session tonight. I just forgot to switch on my microphone there. One of those things that makes it a more educational experience if you can hear the session facilitator. I hope you're all well. I hope your week's been good so far. Thank you for popping in, both you wonderful people who go to webinar and, of course, you guys on YouTube. You're all very, very welcome here. And thank you very much for coming to join me in what is an interesting, it's sort of bringing together a few sessions that I've done of late, but putting it into a context which sort of takes into account everything that we've talked about. And I thought it was a really good sort of reinforcement for what we're trying to do here, which is really along the system design line. Talked a lot about price action. We've talked something about probability. We've talked a little bit last week about multi-time frame systemization. So I just thought I'd bring all that together in a session today, as well, of course, as checking out markets and see what's happening. It's moving through some interesting price action in a number of assets over the last 24 hours, particularly. Of course, as we start, just a reminder, this is for educational purposes only. Please make sure you do your own due diligence on anything you see here. Make sure you follow trading plans. Make sure you manage risk on every trading action, that's entry and exit, consistent with your own personal trading objectives and financial situation. Thank you so much for everybody who said hello. Thank you very much for the heads up on the sound, David. I'm Wayne. I hear you, Brian. Good to see you here, mate. Hi, Hugh. I hope you're all very well. Obviously, this is your session, so if you've got any questions or comments or any of that sort of participating stuff, then please feel free to ask away in the questions box. G'day Sonia, g'day Wayne, and everybody who's watching on YouTube. Quite a healthy group there. If you wouldn't mind clicking the likes, of course, if you click the notification button and put the bell on, you'll get notified whenever there's a new session coming up. We've obviously got live market update tomorrow lunchtime on YouTube. We may move to go to webinar and do exactly what we're doing here, so do a joint stream on go to webinar on YouTube, so you've got the choice. Anyway, that's where we're at right now. So let's get into the session. And as we always do, we're going to start with what's happening in markets generally. A few market drivers now which are of interest. Obviously, the US government shutdown is now what you would determine as prolonged, and I think the market's just about had enough. Outside of the human element, which is not particularly good, the current administration is trying to chop off healthcare subsidies and now food support for those who are less fortunate. The US public is getting a little over it. It is a Republican issue. The Democrats are digging their heels in, say, well, look, if you want everybody to double the healthcare, then we're not going to support that. So it's an interesting situation that the US is in. There's certainly enough theories around there that it actually doesn't do the administration any harm in terms of getting things done, signing executive orders, firing a lot of people, all that sort of stuff. So it's a very bizarre situation and something that's very alien to us all, of course. Thank you, Michael. I am well. I hope you're good too. Now, on the positive side, let's on the third point there is probably related to this, in that we had some elections last night. We had the New York City mayor elections. Mazohan, what was his name? the Democrat got in. There was Andrew Cuomo running against him, and that was sort of interesting. I'm just trying to get my YouTube up as well. Keep playing. Yeah, so Zoran Mamdani's victory was good. Gavin Newsom got what he wanted in California, which was to readdress or to reorganize some of the districts in terms of voting, which is essentially replicating what Trump did in Texas. It's addressed the balance 5 and 5, expected seats on either side. Also, there was Virginia governor and one other. So, but essentially there was a blue wave got slapped, which suggests absolutely nothing really. But really interesting if you like that sort of thing. On the positive side, US earnings. We're in the middle of earnings season. If you're not familiar with this as a site, FactSet is just fantastic. They produce a report every Friday. It's absolutely smashing out of the ballpark. 2/3 of the S&P reported as of last Friday. 83% are beating EPS expectations and 79 a positive revenue surprise. Growth rate's 10.7%, which is better than last earnings season. Obviously, lots of companies. The other sort of, if you like, elephant in the room is the impact of AI on an economy which is really struggling in the US. Not only is inflation sticking, in fact, creeping back up again. Although I don't think that is going to impact the Fed's desire to cut in December. I think it might dissuade them from maybe doing an early January cut, an early 2025 cut, but we'll see what happens with that. And jobs, we don't get any jobs data, of course, at the moment because the government shut down outside of the private sector, which isn't looking very good either. But we've got some of the big boys are cutting big in terms of jobs, plus what the current administration is doing as well. So maybe there's a reason they're not wanting data to be out there. Anyway, another story for another day, but earnings are great, and that has been keeping markets up until yesterday. We were sort of kissing record highs again last week, and then all of a sudden we got a major risk-off event. The reasons for this are possibly twofold. First of all, there was starting to be concerns that maybe AI is in terms of where it is, and where it is spectacular. As many of you who do the EA course know, we use AI quite a lot in terms of model development and refinement, and now a few of the smart things on the side. But despite its gargantuan process, there is talk of there being a bubble. The second thing is, of course, perhaps the election results, which were pretty predictable during the latter part of the US session, just twitched the markets a little bit in terms of a little less certainty about where things might be and where they might go, and things that Trump said didn't go down well either. And that decreased potential of the Fed cutting early 2025. As I said, it's pretty well locked in. They'll do a December cut. The RBA were quite significantly hawkish as well, saying they're not going to cut rates again for a while. And so what we saw is this. Now you can see there there was a 2% drop in the Nasdaq. Surprisingly, that was the one that got hit hardest. The Russell was not far behind. From an interest rate point of view, the Russell often suffers a little bit, and the S&P for 5% to the downside. And the Dow hung on by its fingernails, but you can see on which some of the big tech stocks suffered. If we look at the Magnificent Seven, there's 4 of them are at the top, just getting belted. Apple did okay. Google, Meta were down. Tesla, Amazon, Nvidia, and Microsoft all looking awful. So look at the futures. Of course, we've had follow through in Asia and in Europe. Look at the futures; they're fairly flat. The Russell's gained a little bit of ground. The Dow looks as though it could be where it is. European futures looking okay. We're going to bounce in Bitcoin after being absolutely belted over the last couple of days, down index or down 10% to correction territory. Really interesting chart. I'll show you in a moment. And gold seeing some buy-in today as well. Likewise, copper, a bit of weakness in the USD. We'll have a look at some charts in a moment, but just to give you a heads up on where we are. You can see the major European markets. Look at the CAC Caron, that's neutral. FTSE is neutral. DAX is about 0.5% to the downside. Now, this is a lot of this happened last night. If you just back, you can see we're already selling off. This is where the European markets close. We're already sold off significantly by the time European market closed, which is why we're not getting belted to the tune of some of the US overnight. If we look at data that's coming out, those data points which will come out, then what we had some reasonably ordinary jobs data coming out of New Zealand. Very little else to jump up and down about, but it is the first week of the month. Now, this is going to be quite important because this will come out. It's the ADP, which is a survey. For this book here. It's not government orientated in terms of being, it's not released by the government, it's done by a private sector company. So it's indicative of where the jobs may be. We've also got the BOE doing its interest rate decision tomorrow. It doesn't look as though Forex Factory is suggesting we might get it should be non-farm payrolls tomorrow, sorry, on Friday. And at this stage, they're in. But there's no expectations, which suggests that we're expecting it to be released. We should have US weekly jobs tomorrow as well. No, so we're sort of counting on these sort of peripheral jobs data to make judgments on what's happening. Also, the Swissy, sorry, the BOE is expected to pause rates, as did the RBA earlier in the week. So watch for that ADP non-farm employment change. That's going to be a really interesting number. If that's very soft, I think the markets are going to continue to sell. We still haven't had a significant pullback until, of course, if we just pop back to the NASDAQ, there's a new panel for those of you who are interested. You can see the gold and silver ratio which is a new panel, is trending to the downside. GB pound Swiss, it looks like it's worth a look at. Commodities generally doing okay. Here's the NASDAQ, and you can see that pull down. Now, this isn't dreadful. And bear in mind, the NASDAQ has moved up since April. It's still up 55%. So the pullback is really quite tame. It's not even much more than 3%. We'll see more in this to the downside, particularly if that jobs number comes in soft tonight. One of the reasons why we're seeing a little bit of risk off, or one of the symptoms of us seeing a risk off, is some strength in the USD, which is sort of interesting. That's also related to maybe the Fed's not quite as enthusiastic a Fed. No one's getting paid in the US. That's really true. So there's lots of dollars flushing around. Here's gold, which has had a really interesting ride. Of course, we had that major move to the upside. Really, for most of the year, we had that big spike up from the beginning of August right up to record highs at just below 4,400. We had that significant pullback, and now we're sort of battling to stay in this range, just below 4,000 on this futures contract. But it looks as though gold may be starting to attract buyers. I've been watching this 4037 level as a level of interest. There's copper pullback, really sort of range bound. If we take out these lines, you can just sort of see that's the wider range that we're sort of talking about here, between about 490, which it looks as though it could bounce off again up to about 522. That big candle, of course, was when the tariffs were imposed on US imports. And oil just to put this into context, this is lows here from 2021 that were tested last couple of weeks ago. This doesn't look particularly compelling. We've got should have the EIA data out tonight as well. It'll be interesting to see what's happening with that. And then, of course, there's Bitcoin. Now, Bitcoin's having a really nice bounce, and this was a chart of the day. If you look on YouTube, you'll see that chart of the day I put up this morning. But this essentially had a 10% drop in the last 2 days, took us all the way down and beyond this sort of the low on this actually tested the 100,000 level. It did manage to bounce off and finish up above 100,000, which is obviously a really key psychological level. But this essentially represented a low since June. So sort of 5-month lows on this. I've got a bit of bouncing going on today. So this is starting to look a little bit attractive for a potential move back to the upside, if you're that way inclined. I will put it in the high risk trade category. But if you were interested in a bounce, I mean, to me, it looks oversold. If we just want an hour or something of that nature, I'm sure we'll see a little bit of an oversell going on. No. So if we put it on the daily chart, you can see it just bounced off oversold. Actually, it didn't quite breach oversold on the daily chart. It did on the hourly chart. Use a 14. It's the strategy we're using at the moment. So we've got a double bottom on the shorter time frame, sort of interesting. So yeah, that 102 to 280 looks like an interesting point, but just looks very, very reluctant to breach through that. We've got an interesting 5-week, or is it 6-week test? We'll talk about this later. But this looks as though it's more likely to go down and test 100,000 again, to be absolutely honest. So be patient. If it does start to test this, then you could be in for a nice ride to the downside. In terms of FX, US yen has really not done very much throughout the day, trading in a range between 153.84, 153.16. We're mid-range at the moment. Waiting for data to come out, I suspect. Aussie dollar, in fact, FX has just been generally fairly flat. If we just actually pop on the scanner, just have a wee look at, you can see there's very little moving and grooving at the moment. The Swissy looks sort of weak. Actually, GB pound Aussie might be worth a look. Nah. Some work to do on most of these forex pairs because most of them seem to be range bound. Short term, so there's possibly a scalping opportunity now. Let's just check out. What's the Canadian dollar? US Swiss is interesting. Let's just pop that on a daily chart for context. I looked at this yesterday and thought, I wonder. But you can see there, we've got a key level at around about 81.40 on the daily chart. The 200 MA is sitting around about 82, so that suggests a potential 60-pip move. That corresponds to that to some degree, but you'd have to be patient. We're still about 40 pips off that, actually, so there may be even an accumulation opportunity here. So you could potentially say, so let's just pop it on the hourly chart. So we've definitely got uptrend on the hourly chart. You can see sort of higher lows and higher highs, which is obviously really quite important. So at this stage, we're looking to see if we can continue this trend. If we breach 81.08, there could be a move up of around about 30 pips, but the high probability trade is probably if we start to tackle 81.40, because of course, as we talked about last week, this will be a multi-time frame. That's a multi-time frame level. Okay, so that's the one that could be the important one, or indeed could be the pause point. So the short-term opportunity, if we breach 81.10, say, and but as I said, the major one would be this, because it would reach this level here. You can see it was price is quite sticky around about 81.40 really for quite a long time. So that's going to be my chart of the day for FX. The US is a really difficult one to call for the simple reason that some of the cryptos got absolutely murdered yesterday. Let's just have a look at Tesla. It did drop off yesterday, but I'm not sure. Yeah, see, it doesn't pull back with any conviction. Let me just check something. I'm moving quite quickly here. Let me get on to them. Let's just see who's reporting tonight. Okay, so we've got Toyota. McDonald's are reporting tonight. A couple of the... Oh, that should be interesting. Yeah, Toyota, Novo Nordisk, McDonald's is the biggest forecom in the tech space, and Robinhood markets. Robinhood have been actually quite an interesting ride this year. We've got not maybe happened. I'll just be on here. Okay, so what's these actually about? If they generally speaking, this has done very well. It got smashed. You can see it's a while since I've looked at this chart. So it's made its way back down to the 200 MA. That's really interesting. So, oh, that's on the hour chart. So just watch this. This will come out after the bell, I'm pretty sure. So it could be one to watch tomorrow. But keep an eye on that. And AMD got a bit hurt. They've done really well of late. But obviously, like most of the Nasdaq, have had a pullback over the last couple of days. I'm wondering whether this may be seen as an opportunity there, but it doesn't whet my appetite. But if you're wanting a pullback trade, I think AMD could be worth a nudge. Right. So there we go. I'll make all of the MU. What are MU doing? Okay, MU pullback. Just watch MU. I quite like MU. Really strong in the semiconductor space. Did have that pullback yesterday. Extended hours trading looking okay. Just watch 234.60 as a level. I'm going to make this my chart of the day. You can see on a monthly chart, it's just paused there. It was the high for last month as well. So it's got a reason to stay there. But of course, that was the end of last month. So it made its high at the end of last month. Just a little retracement. So we're looking for trend continuation over 235. Right. And okay. Right. We've had a little chat and I made a couple of references to things. Right. So why is this sort of, if you like, this sort of deeper dive into multiple layers of decision making important? Well, really, we're all very familiar with candle patterns. Obviously, a lot of the EAs that we do are sort of based on candle patterns. Watch out for Go EA, by the way. Hopefully, it'll all be released next month. I'm doing there'll be a couple of EAs to play with. An education course, really sort of going to be quite cool. Not quite at the level of the EA program that some of you are doing outside of the Go, but it's going to be good. And it'd be great to have somebody on board who are doing that anyway, just to help along. But the reality is that many candle patterns without additional information fail to thrive. If we look at breakout trades, talked about this a little while ago. you're looking possibly at least 40%. There's about a 40% reliability. And of those that do continue to go up, at least half of those will come back and retest the level that they've gone through. And so, as I said, we talked to some degree about this last week, and I'll bring that context in. What we're doing is we're essentially relying on some simple shapes and ignore where they're forming and how they're forming in the overall market context. The reality is that context is king. So, key message from this, to develop that multi-time frame analysis we talked about last time we met, is the effectiveness of the effectiveness of a candle strategy or a candle pattern depends entirely on the environment it forms in terms of probability of a move that follows through on your particular trading idea. So, for example, if we have a double bottom, then it'll only be a double. We can see it time and time again. If we just look at, it doesn't have to be a double bottom, it could be a double top. So if we look here, for example, it can work on a short time frame. There's a double bottom there. The context within this is that it's within a longer term range on the hourly chart. Let's just take that out a bit so you can see that in more detail. So in the context of this, in terms of the price has been trading in a range, that double bottom there was relatively high probability in terms of a move back up towards this liquidity zone, this resistance level that we see at around about 4037. Whereas if we looked at, there is actually a double bottom here. So you can see there's if we just put this on the line chart, bring it up a bit closer. And pop it on line chart. So you can see a double bottom there. Now, although that's a nice pattern and it would tick some boxes, and you could say, well, look, once it breaks this confirmation point, we're in. The context of this is very different. And the reason it's very different is quite simply the potential upside on this is relatively small compared to this. So although it did move up for some time, once it had breached, you've got that retest I talked about before. So you've only got about, what's that? So let's say you entered on that candle and then a retest. You've only got 1, 2, 3 candles before it starts to drop off again. So this was potentially a higher probability move because of the context it was in compared to that one. So just as a simple sort of thing. Now, if we look at a 4-hourly chart, actually what we'll do is I'm just going to put a couple of lines on here, one there and one there. And again, you can see context. So this has reason to reverse. Okay, this here, where we saw that on the back of that hourly chart, we can see it's actually popped up on the 4-hourly chart. My guess is if we looked at a shorter time frame, you can see there the shorter time frames again has a bounce there. So we've got that multi-time frame agreement. Whereas if we look at this candle here, it's looking pretty ordinary on the shorter time frame. On the hourly chart, we've already said that, well, look, we've got a double bottom going on. But on the 4-hourly chart, that looks a bit sucky. It's trading in a range. It's consolidating. Just put a couple of other things on here. If you look at the ATR, what's happened to the ATR? Tell me what's happened to the ATR. What are you seeing there? Yep, volatility is dropping. What does it mean? It means that the interest is waning. There isn't the momentum there with this particular price move at this point to say, hey, look, that's good. We've got a little bit of increased volume, but if you were to put an average volume on this, that would still be quite low. So that sort of general flick around is just an introduction into the sorts of things we need to have a look at. And the context is important. So really what we're trying to do, if we're developing a trading system, or we're making a decision based on, does this look like a high probability trade, and I need to look at the confluence factors around this, which multi-time frame agreement is one that we talked about last week. We essentially want a tick list of the full picture around it, and it's one of the reasons why discretionary entries are often quite good, because it's easy for the human eye to see the full context pretty quickly, providing, of course, you actually choose to see it and not have a little bit of confirmation bias. And where some of that broader context is sometimes slightly, though not impossible, to program from an automated point of view. So just to reinforce a couple of points, that in terms of probability of a successful trade, candles are rarely predictive on their own. Patterns and individual candles within that pattern really make the chances of a prolonged price move in your desired direction significantly limited, unless it has at least some support or what we call confluence factors. And so what we're going to do is we're going to look at that. We're going to sort of build on the multi-time frame thing we talked about last week. If you trade without context, there is a relatively high failure rate. And you can check this out for yourself. Look at the trades that went well for you. Look at the trades that didn't. Assuming you exited at an appropriate time, you'll be able to see patterns about, well, looking at the picture now, what was the context of that trade, of that losses? In simple terms, if you buy every candle pattern in a trending market, it might not work. If you buy every candle pattern in a choppy market, particularly when you're going against the trend, or you buy in a choppy market or range-bound market, again, it's more likely to create an undesirable outcome. So it's not just about what a candle looks like, but why it's doing what it's doing, and more importantly, when it's more likely to work. So it's that big context. Now, so the key message is, we're wanting to remove some of the randomness, some of the market noise that we can control. Because remember, it's not the market's fault if you choose to get in a trade and it goes against you. You've made the choice to get into that trade. You should also make the choice to make sure that your preparation for getting into that trade, and that includes, of course, how robust or otherwise your trading plan is. Whereas if you work from a place of hope or anticipation, then your results are going to be more random. You're going to have that minimalization bias. One of the reasons that we did these two panels that I sort of referenced before in the scanners, is to just take some of the randomness out of that. So we've got the overall traders dashboard, and then of course we've got we've developed a heap of indicators like such, and then we've got our entry indicators. Which includes a multi-time frame trend and a chart on there, which is sort of beside this dashboard, doing an exit version of that, which means you can do everything on there. But one of the other things which is really very relevant to what we're talking about here is, not only have we got the scanner that looks at various attributes of a potential move in a specific direction, which is this is. So it looks at the candle, the short-term, the long-term trend, where the bar close is, if there's volume is increasing, what the momentum is doing, and what the RSI doing, although this is opposite. So so this supports us. This won't be overbought. Sorry, this won't be overbought because it's supporting a short move. But then we took it to the next level, and we started to work on setting parameters which were relevant, so we can take out some of the hard work of working through 27 pairs and saying, right, which one is doing. So if we, for example, try to look at the Canadian dollar Swissy, you can see that is looking very interesting. In terms of our trend grab is looking for a trend that's moving. Now that is probably getting quite near to where you would sort of, let's look at the euro. I think I might have opened too many charts now. Anyway, you get the general idea. So you can account for this and you can automate some of it as well, just to make life a bit easier or a bit more efficient in finding things. But the key thing is whether it's you doing that or whether it's something reading what's happening and giving you the output to look at as in one of those panels or scanners. What you're doing is you're reducing minimalization bias, which means you're looking at all the things you need to, and having the ability to be objective about when you take action. Consistent with this idea of that a pattern isn't enough, you need context. So context changes everything. Now, I don't want to put the message across the context that candles aren't important. The candle for right now is still really important. It's what it tells you in the right now where the bulls or bears are in control of this current price move on whatever time period you're looking at. So things like closing in the top half if you're looking long, closing in the bottom half if you're looking short, is still really important. And obviously its placement on where it's open and close were, and its placement in context of the candles that were before, because of course that's what creates the pattern. So the individual candle is still important, the pattern is still important. I don't want to dismiss those, just reinforce the point that this is about finding good confluence. So there's three things that I want to sort of have a look at here. So as well as the candle and trend direction. Now, we talked about this at length last week in terms of the higher accuracy, in terms of probability. Probability would have been a better word than accuracy. The logic is really simple. I mean, we can sort of put up any chart you like. Let's do the Nasdaq perhaps. Make it nice and clean. Okay, so it's really not a hard concept. Okay, we look at trend. So there we've got a low. There we've got a retracement with a lower low. There we've got another retracement with a lower low again. There we've got a retracement with another lower low. So we've got lower lows on the bottom, we've got lower highs on the top. That's a trend. So it's a really simple math thing, okay? If you're in a trend, so if we look at this move from, let's say, here to here, that's 0.37%. Your retracement on that is 0.23%, so 2/3. If we look at the next move, so the next move is 0.36%. The retracement on that is 0.15%. We'll look at the next move to the downside. This is quite equidistant actually. 0.24, 0.21 maybe. And then of course we've got the biggie. Last sort of shakeout is there. Is 0.95. So if we added all of those up, I'm sure you don't need me to do that, but if you're going against the trend, your maximum return is what the retracement point, what the retracement value is. So it's that much harder if you're trying to go long on this chart. It's that much harder to make money to get a prolonged move unless you get a complete reversal. Fucking duck pattern there, we'll call it. And of course, as we've told before, then we've got a sort of mini double bottom. There's all sorts of things we can use to see if that was significant or not. And of course, one of the major things we can use is, as I said before, multi-time frame analysis. Is it important? Yes, it is. Look, this was a previous resistance, so it could be then subsequently a support. It's not rocket science, but it involves you doing that. It involves you looking at, and it involves you asking the right questions. That's the bottom line. I hope that sort of makes sense without sounding too dictatorial. When we talk about liquidity zones, we're talking about market structure. We're talking about support and resistance, potential support, resistance, swing high, swing low areas where we may have in the order sitting, which add to price flutter when it gets to there, possibly. And so it's one of the reasons why we look at that key level. If we look at the just sort of reference that chart we just had a look at there, then it is reacting to a key level. So generally speaking, if we look at this, the overall trend is still uptrend, although we have a retracement on the daily chart. But the context is this level potentially here, which is a liquidity zone, which is bounced off. There we go. There's the bounce off that level. So the context is still an uptrend with a retracement, potential bounce off this level. That's what would suggest on the daily chart, on the shorter time frame. I didn't prepare any of this. I'm just doing this off the top of my head. Peter, can I'm happy to do that. Can I get you to email me? I'll put my email address in into chat, so it's in there now, Pete. So if you want to just do that, then I'm more than happy to flick it on through to you as soon as it's recording processed and stuff. So that's what I mean by having a liquidity zone, candle plus liquidity zone. It gives you validity, a validity filter in terms of it is reacting to something, to some previous price action. Remember, previous price action has a massive impact on current price action. So, so is it anti-hour? Is the candle saying yes? It is. Is the current direction okay? Well, it's saying it's uptrend, but there is a retracement, but there could be a bounce because there is a liquidity zone around that level, or where the retracement appears to have stopped. It looks okay. Now, in terms of session time and volatility, it's really important that you take into account session times. We've just currently looking at one of the models we may be developing is one based on VWAP, even though it's sort of volume weighted average price. And really the best way to do that, the best way to use that particular indicator is to do it per session. So it resets at the start of every session. And then you close and trades out by the end of the session. Now that doesn't necessarily need to be your particular approach, but it does stress the need or the reality that things change session by session. We don't have to look at the NASDAQ. We can look at any instrument you want. Let's look. Let's look at the Aussie. Let's look at the Aussie yen. So generally speaking, the Aussie yen could be active in the Asian session. Let's just put on 30-minute chart. But generally speaking, in the Asian session, it's often quite flat for the first few hours. You can see there it's trading. So if we look at that, there's a nice little range tool I've got which could do this really quickly. But if you look at that, the range is sort of quite short compared to the US session, which is this bit here. European session doesn't do much, but we did get a breakout into the European session, which is sort of interesting. That was the exception to in fact, the last 2 days have been quite bumpy, if that indeed is a word. So we often see this sort of, you're welcome, Pete. Look forward to hearing from you, mate. We often get this sort of consolidated action, and often the strategies that work in the Asian session are things like mean reversion. So if you were trading, this is actually not a bad example. You just need to switch that off. So trading breakouts is often quite tricky in the Asian session. If we look at this here, so you can see there's a range. So we could do a bounce off a range. So we identify the range that it's in. There's the rejection candle. There's the move up. That was a really interesting little time, but we obviously got some follow through on that. But if we put a Bollinger Band on it, I'm pretty sure that that might have got quite close to, yeah. So we popped out of the Bollinger Band and then back into it, and that is often a good mean reversion type strategy, which takes us up to the moving average to the candle. So, but if we take that off, you can sort of see that. Actually, we'll leave it on 30 just for more detail. But you can see here, towards the back end of that Asian session, we got a nice breakout. Yeah. So often mean reversion strategy, that could even be into the European session, actually. So we got a nice a mean reversion strategy, which looked really good in the Asian session. A breakout, end of Asia, beginning of European session. And then we sort of got drift down. You would know that that's a good time to get out because you'd obviously go and have a look back. And you can see, where was it we're talking about here? You can see there's every reason to get out at this point. If you go further back, to go back a long way, just put another line there. So is there anything around that area? Let's have a look back. Yeah, there is. There's lots of price action back here. That was a long time ago, a year ago. But there was every reason to suspect, if we just put this on a line chart, you can see this is a liquidity example. We've got loads of limit orders sitting at this point here. That would encourage that to reverse. Likewise here, encourage that to reverse. So multi-time frame again. So what I'm trying to say is that different patterns may be more robust in different sessions. And obviously, at the beginning of sessions, we may get an increase in volatility, which pushes, obviously aligned with an increase in volume. So if we look here, where's our maximum volume? It's at the start of the US session, where last Asian session on this particular pair, because obviously it's instrument dependent, the volume's quite low, but there's quite a lot of action in the Asian session on the Aussie yen for these reasons. Whereas if we look at the Nasdaq, oh, there we go. We've got our range bound, we've got our gap indicator here. But again, you'll sort of see volume is not surprisingly at its biggest when it's at this point here. Let me just put, I've got all these gap indicators on here. Oh no, I was testing something, wasn't it? But if we look here, not surprisingly, let's just put this on the hourly chart. It's just too lucky. But you can see again, volatility is its lowest in the Asian session, increasing in the European session, its highest in the US, unless there's something going on. A couple of exceptions to this, of course, but still really high in the beginning of the US session compared to European and Asian. So it's asset dependent, but also, of course, likewise, volume always at the start of the session. Let's just put this on a 15-minute chart for a bit more detail. So you can see here the Asian session quite flat, volume low. We do get a rise in volatility there, which is interesting. That supported the downtrend we're having for whatever reason there. European session volatility is highest, volume higher again. And then what do you see at the end of the session? It's important to see this stuck down in volume, see it flattening of volatility, stuck down in volume, flattening or lowering of volatility. Again, flattening volume. Now we're in a flat volume period now as we wait for the next chunk of data to come out. And again, flattening volume and dropping volatility at the back end of the US session, unless, of course, there's earnings, in which case we'll see a spike. So there's two things to do with sessions. First of all, there's often the open and close. More traders come in. We'll get an increase in the excitement, increase in participation, increase in volatility. And of course, the other thing, of course, is we often have data releases around that time in pre-market. So there's a number of factors to keep an eye on what's happening at open. There's a few strategies that trade open. There's a strategy that we've got, which is an open bar range, so an OBR. We extended that to the open 3-bar, so it's a really simple strategy. Let's just do it at the Asian session because it's easier to identify. So what we do is we look at the first 3 bars, 1, 2, 3. There's the high. There's the low. So we're looking for a breach either side of this. So we could have taken that short, we could have taken that short, etc., etc. If the start of the US session was 1630, platform time, which it is at the stage. I just wanted to check that. It's one of the panels that tells you what time markets open for MT5 time. I was looking at that. Yeah. But if it's 1630, what we might do is we might look at the candles around about 1630. So we look at 1630 here, and then we take so the opening bar in this session is here. The first 3 bars, probably too late. But we'll catch a little move there, and to the downside, catch a little move there. If we're taking the first bar, which is a single bar we're using on the US session, which is often a good one, I'm sure I'll take the 15-minute bar. Yeah, okay, so if we took the 30-minute, there's the opening session, there's the first bar, there's the move to the upside, we could potentially grow. Can you please look over pound pairs? They're all down. Certainly, Stephen. We use those as examples. So if we look at GB pound, they're all up. Depends which side you're at. So if we look at GB pound Canadian dollar, I'm wondering what's happened at the Bank of England come out and said something. But yeah, I mean, even if we looked at the sort of and if we look at the scanner, there's all the GB pound. Lots of greenness going on, suggesting they're about to move. GB pound yen might be interesting to have a look at. Let's just stick it on there, see if it's breached something. Bit flat against the Aussie. Let's have a look at it. So GB pound Canadian dollar. So we've got a breach outside of range. It's just another indicator we developed this range pound. So that's a breach of a range. GB pound Aussie, breach of a range. Oh no, that's a bounce. There's a liquidity zone I talked about before. In the general context, it's sort of slightly up if we just put it on if we put it on a 4-hourly chart. You can see it's struggling to get out of there. So this is more a sort of mean reversion type sort of pattern. Potential double top there going on with a little bit of this is what it looks like for you guys who are going to get this. This is what it looks like as it's formed. So as soon as it's met those criteria, then you've got that range going on, and then when it breaches, you can do something about that. So GB pound's looking quite strong actually against most pairs. GB pound Canadian dollar is looking the most interesting. Canadian dollar looks weak against just about everything. I don't think there's been anything. So they're sort of down in the last. If we look at this in the 15-minute chart. So again, what we've got is we've got a nice bounce off a key level. There's a liquidity zone there. It bounced off. There's the reversal pattern. Looks like a reverse head and shoulders-ish. It's a triple one maybe. And there was the move. And now we're at profit target territory, really, to be honest. Nice. So the pound pairs are good, but maybe just run out a little bit of out of a little bit of steam if we're looking at the charts. See, again, we've got potentially a line here that sort of says, well, this could be the pause point here. So that was the low. You can see there the was on, so that was a low, and then we had a pause point here on this way down. So it wouldn't be surprising to see if it pauses around this 254 again. If you were in this trade from a bounce strategy, for example, you'll be thinking, maybe that's done. And one of the reasons it may be done, of course, is because we're coming to the back end of the or that sort of quiet period in between that early enthusiasm in Europe. Let's watch for this in a little while. Just trying to work out off the top of my head. Can't do it. So a couple of hours into the European session. I need to adjust on my times because the time zone changes. A couple of hours into that, and we are 2.5 hours till. No more than that. 4.5 hours till the US Open. Watch for the next couple of hours. There's possibly another couple of hours left in the European trade. So if you were trading sessionally again, if it hasn't done its move and there's only a couple of hours left before the US market opens, you might just sort of get out and then reset and then see where it's at, or tighten stops or anything like that. So it's not just, although the focus of much of what we've talked about today has been on entry, it's not just about entry, of course. It's about using those same principles to say, well, maybe it's time I pulled the plug, or maybe it's time I took some off, or maybe with volatility dropping as it is, you see no further increase in volatility in that. Put on a 30-minute, just a slight touch. What's the MACD doing? Sometimes it's good to slap on a momentum indicator onto these once you're in. That's not really telling you as much. See, okay, so if we just went on these indicators here, then and ignored this, which is really important, ignored this level here, then we're potentially lending ourselves to a little bit of a major give back, because that's obviously what we're trying to do with an exit. It's not only manage capital risk, but we don't want to give back more than we need to. So if we ignore this, if we don't have a liquidity zone stroke resistance, previous level, previous swing high, pause point, whatever you want to call it, in part of our decision making, it'd be interesting to see, because this happens time and time again. It did here. Let's find a good example of that. Okay, so here's a good example of that. Here's a good example of that. So we got a breakout here, and we're getting very excited at this point here. We see this bounce. Why wouldn't you get out here? Or resistance for a reason. Why? Is it resistance? Because you've got a heap of people saying, oh, it's going to bounce downwards off that again, so let's put some sell limit orders there. That starts the ball rolling. It's running towards the back of the US session. So chances of a big move are limited anyway. You can see volume going down. You can see volatility going down. That says get out. Mess. Thanks, Stephen, for pointing that out, by the way. So, like candle plus timing plus session time plus volatility. Often increased volatility is generally associated with a move of significance along with increased volume, of course. So we can do it in 3 layers. We discussed trend context last week, bullish candle and a downtrend, maybe a trap or a best, just a far lower probability of it going in prolonged direction against the overall trend, unless there's signs of a reversal. Trend structure, as I said, really important to keep an eye on higher highs, lower lows. Really simple concept, but they're markers. They're a symbol of market structure, and that's really important. And we talked last week about the merits of 3 time frames. You don't want any disparity across 3 time frames. You may choose to be a little more conservative on the longest time frame, which, as you just saw before, I talked about that daily chart, but it's retracement and it hasn't retraced beneath what was the previous resistance. It's actually using that as a liquidity zone. We'll talk about that in a moment, of course, which is the liquidity context. Because liquidity zones attract price to it, but also prevent traps. We've often got pending orders, we've got algos, all of which play these to the nth degree, and more so as we move on through the weeks and years of algos getting more and more sophisticated. So if the algos are looking at them, and if retail traders are looking at them, why wouldn't you? So don't be shy taking a profit off, because let's say you had that bounce off a range, don't be scared to take the profit off at the top end. Don't be scared to take the profit off here, because the thing is, if it does this, then you've lost nothing. You've locked it in. And if it breaks through, then you've got another chance. So here, for example, was there a reason why that was yeah, because it was here. So there was a reason why this line is here. So there was a reason why there was a pause and retracement at this point here. So we take it off here. As soon as we see that happening, as soon as it gets near this level, we say, right, we'll rip it off, knowing that if it goes up here, we've won, and if it comes down here, we've got a high probability trade again as we get trend continuation, because it's breached that and it's breached that. So we then make another chunk of cash. It's not hard. It's just hard work to make sure that you do it. That's really what it is. So when people talk about liquidity zone, they're talking about key potential. They're talking about pause points, resistance, support, swing highs, swing lows, watch wicks, rejection of a particular move. There was a strategy we developed, which is a 5-wick strategy. So you can see here that line 1, 2, 3, 4, 5. That was 6 wicks, and then it reversed. Often good when you're hitting a high that you haven't seen before, or a high that it hasn't hit for a while. Here's another example: 1, 2, 3, 4, 5, 6. A 6-wick rejection and move back through the low of those candles. That's a lot. That's a short. Now there's reasons we wouldn't have taken that, because of the proximity of this liquidity zone here, or this support, if you like. Let's just go into another. Let's just go into another random one. Let's look at the Aussie Kiwi. So now what we've got here is really interesting. So we've got this pullback, really interesting price action on the Aussie Kiwi. So we've got a pullback here, and we've got 1, 2, 3, 4, 5, 6, 7, 8 rejections for a move back through 147.40. That's looking like it's not going anywhere. Now, would you get into that? No, you'd look at the high of that series, and you'd say, right, okay, if it breaches this, there's the wick rejection. We're going to move over here. We're back into this. We're trading this up to 115. Does that make sense? So wick rejections are really, really important in terms of the context of liquidities. Um, I'm just looking through questions. Um, there's something called a liquidity void, which is not something I would have a look at, but the essence of it is don't join in a trend when it's already gone. Okay, so for example here, let's find a good example. Okay, so we've got this going on here. We had a nice little bounce off this level here. 3931. Nice little wick reversal, however many you want to do. So the entry on this was probably over this candle here, close over this candle here because of this price action here. So that was probably the candle to get in. Once it gets to here, you're done. There's no point in bandwagoning and jumping. Too many people do this, and it's how a lot of people lose a lot of money. Is because what happens there, and again, it's not so your risk reward here, okay? Realistic risk reward, not a sort of take a guess risk reward. So your risk here is probably around about 0.3%. Okay, your reward here is about 0.6%. So it's a risk reward. If we, however, don't enter for this candle here, then our reward is 0.3%. Our risk is possibly goes all the way down here and then breaches that, so it's about 4%. So at best, you could say, oh, it's nearly 1-to-1. You'd probably talk yourself into that 1-to-1, but it's too late. There's a liquidity zone sitting here. It's just too late. So bandwagoning at this stage when there's a liquidity void, there's the two key levels, the two key zones, if you like. You can create a zone here if you want to, turn a zone here if you wanted to, which would take into account things like wicks and stuff like that, which is what that indicator thing and that sort of range bound indicator does. It uses wicks as well. But this is a liquidity void. There's nothing really, once it gets over this level, there's nothing really stopping it. Previous price action, but it's current price action, nothing really stopping it to get up to that. So to enter here, expecting it to go high, it's not going to go very far because the next liquidity zone is not going to give you enough. Proximity is a big issue. I should have maybe sort of stressed that more in the presentation, to be honest. Time of day context. Lindop is very different to the Asian session. Same candle, different volume, different follow through with that. Much of this, of course, particularly when you get to the US, our impending US Open, a lot of the US data is released now before the US equity market opens. So that creates its own individual volatility, and then we tend to get a bit of a slingshot approach once the equity market's open. Obviously, volume's a key thing as well as the other things that we've talked about as well. So a bounce with higher volume suggests conviction. Just because there's more traders looking at it, that's why we get the higher trading volumes at the start of sessions, because everybody's woken up and is very excited. Institutions are busy, market makers are busy, and then after that initial foray into lots of people wanting to get into the markets, then often we get with institutions, if you see trading volume, you'll often see very bizarre on the ASX even. You'll see a little bit of a spike in activity, but then you'll get sort of several trades every few minutes or every half an hour or every hour 53, 53, 53, 53, 53, and that's institutional accumulation. So we like this, says the institutions, and we'll just keep on buying some over the course of the next few hours. So that when we do get our bigger move at the end of the day again, we've already got a chunk of accumulated positions. So it doesn't mean when we talk about institutions and market makers being more active, it doesn't mean that they become unactive. It just means that they aren't interested in any way, shape, or form in moving the markets. They just want to buy or sell where they're at right now without moving markets significantly anyway. So session timing dictates generally which trades may be worth taking, perhaps when not to be still in a trade. So towards the session end, when you've got volatility dropping off, you've got volume dropping off, you've got the potential of some data coming out, we're about to flick into a new session. Maybe that's time to get out. Or maybe that's time to take some money off. And then the volatility context. Volatility, look at volatility expansion and contraction you can use, but really that's up and down. You don't have to use it. You can see it on Bollinger Bands quite easy, but you can see it in ATR. If it's a low volatility environment or a drop in volatility environment, you're unlikely to get a big move. Big moves come with high volatility environment, of course. That increases risk. And of course, you need to review your stops and targets accordingly. Volatility contractions may suggest signal exhaustion, pattern exhaustion, price exhaustion, lots of exhaustion going on all over the place. People just need to lie down, a little bit of a siesta. But there's less likelihood of a follow through rather than continuation, which is, of course, what we want to see in many price action contexts. So if we're trying to bring this all together, and I hope it's sort of been useful in terms of doing that, the reality is that an identical candle pattern can give a different result depending on context. It's why sometimes you'll see very nice patterns work, and why sometimes you see them not. If you go back and have a look at some of those trades, find the trade you took, why you took it, if it was based on a pattern, and look at some of the things that we've been talking about today. So look at volume, look at liquidity zones, look at where it sits in the course of the day. Look at those things and see if adding those layers would have helped, not only in terms of persuading that it's actually a good trade to get in, but also, well, maybe it's not. If you trade less often, but those less often trades make more money, then it's usually a good thing. Context, looking at context is vital. Context is king in terms of developing a system which will work for you. So 4 key questions. Just make this a checklist for yourself when you're thinking of entering a trade. So first, price. The first question is, where is price in trend structure? Or with or against the market's direction. Of course, we showed you that in really simple terms, in looking at retracement in a long-term trend, looking at how far it moves on a retracement versus how far it moves otherwise. Often those retracements are not associated with liquidity zones very well, or may create a new one, which might be useful in the future. Is liquidity present near the signal? So we're looking at proximity. If the proximity is too close, it means we may be trapped a little bit. Or have we broken through a liquidity zone or support or previous price high or previous price low, and we're in a state where price action is freed to some degree? And of course, once markets see that, you get increased participation, increased volume, all that sort of stuff. What session time is it? If it's moving towards a time in the session, whichever session you're looking at, where activity is likely to be lower, then will it have the strength to follow through? Will there be enough people wanting to push it one way or the other, or new in market information which might do the same? Is it a good time? Do you see that sort of, we talked about the OBR strategy right at the beginning of a session? Is that worth having a look at? And then what's the volatility regime? Because if volatility is increasing, if volume is increasing and it's going in your direction, there's a better chance from a probability point of view that it's more likely to get nearer your target. But don't be shy if the rules of the game change in terms of price action. It starts to lose momentum, or it's getting near that liquidity zone. Don't be a FOMO guy. Just get out and be ready to go again if it does breach. So those 4 key questions, I think, are probably most traders are aware of, and I'm pretty sure that a lot of what I've talked about tonight would have made sense to you. It's not rocket science stuff. It's stuff that a lot of people talk about. But the key question to ask is, how are you doing it? Are you asking these 4 key questions before you get into a trade, which gives you another few seconds thinking time anyway, we're not getting too excitable. And if you ask these 4 questions, a great way to do this is to look back at trades you've taken, or look back at the charts, ask these 4 questions when you got entered. And how many ticks did you get for those that went your way versus how many ticks did you get versus those that went against you? Just do the math. Those are your 4 key questions. I hope that helps a little bit. So whether you're an automated trader or whether you're a discretionary trader, those factors, those key questions, and those layers that I talked about, are they worth, you need to make a decision for you, are they worth integrating into your trading system or not? Or your coding system? And of course, make this a system. I mean, even if this session has just been one that says, right, yeah, I'm doing that, I'm good. If there's gaps there and you think it might be worth looking at, the key is performance, is evaluating performance. If you don't keep a formal journal on an ongoing basis, this is a really easy thing to just look back at trades you've taken. I'm sure you know that. Anyway, so the gauntlet is thrown down, ladies and gentlemen. Go do some stuff. Thanks, Brett. Always great to see you here. How far do you look back? Weeks, months, years? Till the last one, David, is essentially. Some people would say that it's not worth looking back more than X number of candles, but I think for shorter time frames, that's once you start moving into the previous day, then you're a little loose, unless you're looking at days high or days low. But if markets are always looking for something to hang their hat on, to answer the questions, how far is this likely to go, and is this move important? So in some cases, it might be that if there's a recency, I'd have to measure this to be sort of what's the word I'm looking for? To be more convicted about it. But I think there's probably something in that probability may decrease the longer time it was away, but that doesn't mean the markets aren't looking at it. So it might be that if there's some recency to the last time it tested, then that's really a signal to action. If you're starting to look back weeks or months or years, as you say, then maybe you use strategies such as take some of it off, because you can always get back. And the reality is, if there's something there that says it may pause, and you take it off, then what you're doing is you're locking that money into your account anyway, and you're ready to go again if it subsequently moves through whatever was the causative factor. And the cost to you is very little, and it's only sort of, oh, but what if it goes even higher? Is the FOMO thing. But if you've got a reason, the chances are that if you've got a reason to, or if the market's got a reason to think, should I or shouldn't I, then there'll be some people who will, and therefore that might precipitate a turn anyway. I hope that makes some sort of sense. Mark, you're so welcome. So thank you, guys. I really love your comments and your questions and all that sort of stuff. It keeps me sharp. It helps me think about other things also that I may have missed along the way. watch out for that ADP report tonight. I think it could be really interesting, as I said. And thank you so much to all of you who have watched and said hi on YouTube. I'll catch you later. Take care. Bye bye for now.